18 banks have looked at this company and put an average price target of $72 on it. The stock trades around 35. That gap isn't a rounding error. It isn't a disagreement about one quarter's results. A gap that size means the market and the analysts are pricing two different companies, one that exists and one they think is coming. And the whole question is which version is right. Most people who know the name IREN at all know it as a Bitcoin miner. That framing is doing a lot of work, because the moment you label something a Bitcoin miner, you know exactly how to think about it. Cyclical, volatile, tied at the hip to a price you can't predict. You apply a discount, you move on. What if the label is just wrong? Not partially, structurally. What if the thing being priced as a crypto bet is actually something much harder to build and much more valuable in the world we're moving into? That's the question this video is actually about. Start with what's already happened, because a lot of this story gets told as a future promise, and it doesn't need to be. In the fiscal year ended June 2025, IREN reported $501 million in revenue. The year before, it was $187 million. The year before that, $75 million. That isn't steady growth. That's a company accelerating. Gross margin went from 44% to 68% in a single year. That shift tells you something important about the cost structure. IREN owns its power infrastructure and buys electricity at roughly 3 to 4 cents per kilowatt hour. Most competitors are paying more than that, sometimes significantly more. And they're locked into agreements they didn't negotiate from a position of ownership. When your biggest operating cost is structurally lower than your peers and fixed by assets you own, margin expansion isn't a strategy, it's a consequence. The company flipped from a net loss to $87 million in net profit. Operating cash flow crossed $245 million. That cash is real. It's from mining, and it's being generated before any meaningful AI revenue shows up in the numbers. AI contributed $16 million in FY 2025, so the profitability story, the current one, is almost entirely mining. Now the honest counterweight. Free cash flow was negative by more than $1 billion last year. That's not a typo, and it's not a crisis. It's a capital allocation decision. The company spent aggressively on miners, GPUs, and data center builds in Texas. When a company runs negative free cash flow because it's building assets faster than they generate returns, the right question isn't, is the bleeding bad? It's, what are the assets worth? That's a different analysis entirely. Balance sheet. $564 million in cash at year-end, with more raised since through equity and convertible notes. Current ratio just under 5. The company isn't running out of money, it's deploying it. The financials tell a specific story, a mining business that is already profitable, already generating cash, and funding a second business that hasn't contributed meaningfully yet. That second business is why the gap between 35 and 72 exists. In the AI build-out, everyone talks about chips, GPUs, NVIDIA, the H100, whatever comes next. Chips are real, but they're not the constraint. Power is. You can order a GPU. You cannot order a grid connection. Permitting, land acquisition, interconnection agreements, environmental review. The process of securing large-scale power for a data center runs years, sometimes many years. And demand for AI compute is moving on a timeline that doesn't wait for permitting queues to clear. IREN has secured more than 4.5 gigawatts of power capacity. 810 megawatts are operating right now. Another 2.9 plus gigawatts are in development in Texas. That's not capacity on a slide deck. It's land owned, interconnection secured, infrastructure being built. The renewable dimension matters on two levels. First, the economics. Hydro-backed power in Canada, Texas ERCOT with renewable energy credits. The cost structure is predictable and low. That's where the margin advantage comes from. Second, and increasingly important, the sustainability requirements of major corporate AI buyers. Microsoft doesn't sign nine-figure contracts with companies whose power supply is carbon-heavy or unreliable. The renewable model isn't a branding exercise, it's a qualification. Here's the question I'd sit with, honestly. What would a hyperscaler, an Amazon, a Microsoft, a Google, pay to own what IREN owns rather than rent compute from it? These companies are desperate for power. They are acquiring land, lobbying for grid priority, reactivating decommissioned nuclear plants. IREN already has the position. What is that position worth in a market defined by shortage? I'm not going to answer that for you. The math depends on assumptions you'll have to make, but it's the right question to be asking. The Microsoft deal is the moment the AI pivot stops being a narrative and becomes a contract. The structure: approximately $9.7 billion in GPU cloud revenue, with a deployment target of around 150,000 GPUs by late 2026. At that scale, the implied annual recurring revenue exceeds $3.7 billion. IREN did $501 million in total revenue last year. If the GPU ramp executes, the revenue base doesn't grow, it transforms. The current AI contribution is small, $16 million in FY 2025. In the most recent quarter, AI was about 3% of revenue. So the story being priced at $72 is not the story that exists today. It's the story that exists if the infrastructure build goes according to plan and the GPUs get deployed on schedule. Why is IREN able to compete for this business at all? The hyperscalers have more capital, more engineers, more brand. The answer is the combination of things that can't be replicated quickly. Owned power at below market cost, direct-to-chip liquid cooling that keeps GPU performance and longevity high, and a build timeline that others can't match given where they are in the grid queue. IREN isn't competing on size, it's competing on position. Here's where I want to push back on yourself for a second. If you already believed IREN would hit $3.7 billion in annual AI revenue by 2027, would $35 a share look cheap or expensive? Most people who look at this stock haven't actually done that exercise. They've looked at the current revenue, seen it's mostly Bitcoin, and applied a minor multiple. That's not an analysis of what the company is building. It's an analysis of what it looked like last year. That said, believing something and it being true are different things. The gap between 810 megawatts operating today and 4.5 gigawatts in the pipeline is a lot of execution still ahead of it. 3 risks ranked honestly. The first one is Bitcoin. Mining is still around 91% of recent quarterly revenue. The operating cash that funds GPU expansion comes from mining. If Bitcoin sustains a significant drop, below roughly $60,000 is where margin starts compressing meaningfully. That cash flow shrinks. IREN is not immune to crypto cycles. The AI infrastructure build is being funded in part by mining profits, and that link matters. The second is execution. The gap between what's operating and what's in the pipeline is enormous. Grid connections, permitting, GPU delivery timelines, customer onboarding. Any meaningful delay on any of these compresses the revenue ramp, and with it, the valuation story. The AI upside is real, but it's contingent on a build process that has a lot of moving parts. The third is valuation itself. At an EV/EBITDA of roughly 18 times, the market has already priced in a significant portion of the AI narrative. If the ramp is slower than expected, not canceled, just slower, multiple compression can keep the stock flat or lower even as earnings grow. You can be right about the business and still get the timing wrong. What doesn't look like a serious risk? The debt structure. Convertible notes with low effective rates, a cash position now exceeding $3 billion after recent raises, and a current ratio near 5. The company isn't in financial distress. It's in an aggressive build cycle. The regulatory environment for renewable energy and AI infrastructure is broadly supportive. The power contracts are locked. The land is owned. The picture is a company with real assets, real cash flow, and a real contract with Microsoft, executing a build of unusual scale, funded partly by a volatile revenue stream, priced for a future that's plausible but not guaranteed. That's the honest summary. Hold all of it at once. Two valuations, two different questions being answered. Guru Focus puts intrinsic value around $13. That model treats IREN as a mining company and applies a conservative asset-based framework. It's internally consistent. It's answering, what is this company worth if the AI pivot never materializes? 18 analysts put the average target at 72. They're answering a different question. What is this company worth if the GPU deployment executes and AI revenue scales toward the numbers in the Microsoft contract? Neither is wrong. They're pricing different scenarios. 3 conditions, 3 outcomes. If GPU deployments proceed on schedule, Bitcoin holds above 60,000, and AI revenue reaches $1 to $2 billion by 2027 or 2028. Something in the $70 to $100 range is defensible. If deployments are faster than expected, Bitcoin moves above 90,000, and the GPU fleet hits full capacity ahead of schedule. Bulls get to 120 or higher. If Bitcoin drops hard and the AI ramp slips 12 to 18 months, the floor is somewhere in the $15 to $20 range. Notably, that floor is still supported by the underlying power assets and cash. The assets don't disappear in a bear scenario. They just take longer to generate returns. The single metric I track most closely isn't Bitcoin price. It's quarterly GPU deployment disclosures. Every quarter, IREN reports how many GPUs are operating and generating revenue. That number tells you whether the AI story is executing or slipping. Everything else, the Bitcoin price, the macro environment, the interest rate, feeds into the picture. But the GPU ramp is the variable that determines which of those 3 scenarios you're actually living in. Which of those scenarios do you think is most likely right now? That's a real question, not a rhetorical one. The answer depends on how you weight execution risk against the power position, and how you think about AI demand over the next 3 years. Drop it in the comments. I'm curious where people actually land on this. Here's the simplest version of what IREN is: a bet on a specific kind of scarcity. Not the scarcity of Bitcoin, the scarcity of clean, owned, large-scale power in the age of AI. That's what the assets are. That's what the Microsoft deal is pricing. That's what the 18 analysts are reflecting when they put 72 on a $35 stock. Whether it pays off depends on execution and on whether AI infrastructure demand stays as supply-constrained as it is today. Both of those things can be tracked. Neither requires prediction, they require attention. The power position is real. The cash flow is real. The contract is real. Whether the market catches up to those facts on your timeline is a separate question, and an honest one. One last thing. This video is for educational purposes only. Nothing here is financial advice. Whatever decision you make it based on your own research, your own risk tolerance, and your own judgment. That's your call, not mine.